In this part, we're going to go through how the markets respond to news events, or how the news affects the markets in an introductory sense. So fundamental analysis and sort of the understanding of data points, economic indicators, macroeconomic events, central banks, the sort of interweb, like how they all match together, context surrounding the market. It's a very, very complex thing. So this isn't meant to give you a broad understanding whatsoever. It's just an introduction so you understand roughly what's going on and how to actually interpret the news events somewhat and how they may affect the markets. So let's begin with economic indicators to start with. So remember in the last part, we went through the actual, the forecast, and the previous. And I mentioned a term called pricing in, or something that has been priced in. So I'll sort of explain that in a bit more further detail now, so you can understand how the markets tend to respond to these economic indicators. So let's imagine that we have a chart of euro dollar, right? It could be anything, but let's say it's euro dollar. And euro dollar is on a bit of a sort of downwards trend. Let's say this is a 1 hour chart, and we are around here at the time that we're looking at the market. And we have a data point coming out. Let's say that we're at 13.25, right? So we're 5 minutes before this dollar event. So initial jobless claims, it's expected to be around 300. It was previously 293, and because this is a event which a lower number is a good thing, because a lower number will be less people filing for joblessness. Therefore, if this comes out lower than expected, that could be a boost to the dollar. So remember that we're looking here at euro dollar. So that's our base pair, that's our quote pair. So it's the euro against the dollar. Therefore, we have a potential for, if that comes out lower than expected, so let's say we have a figure that comes out at 100,000, right? So 200,000 less than expected, the dollar could get bid up, right? And the dollar could actually start increasing in value all of a sudden as investors price in the new figure. So at this point in time, 5 minutes before, the 300,000 is priced in, right? So the pricing in just means that investors have bought and sold their positions in expectation for it to be 300,000. So they're happy taking on that risk for that figure. Now the market comes out, or the data point comes out 200,000 less, and EU all of a sudden goes boom and spikes down to the downside. What's happening here is this is a good data point for the US, which then, the reason why this makes the dollar go up is quite complex. There's a lot of factors, but in a really basic, simple form, the central bank is like the main driver of prices, right? Because the central bank is who control the money supply, right? They are the money effectively. So if they decide to change something in their policy, they decide to increase or decrease interest rates, increase or decrease quantitative easing, bond purchases, all these different tools that they can use in the economy, then that's going to influence the demand and supply of that currency against another. So if the jobless claims come in quite low, that means that employment data is good. That's like, getting closer to what's called full employment. Therefore, that's good for the central bank. Maybe then they can start to think about taking certain actions sooner, which would increase the appetite for investors to buy dollars. So there's a lot more to it than that, but I'd be explaining it for too long, too in depth for an introductory video. So it's simply the fact that each of these data points on their own aren't necessarily that important, but when you combine them with the overall picture and how that influences this, which influences that, which influences this, it always ends up with the central bank at the end of the day. And some periods of time, some of these data points will be more important than others. So at the moment, things like joblessness, or like actual jobs data, and inflation data is extremely important, more so than even usually, because of at the time this video has been recorded, as the world comes out of the COVID recovery, and we have markets, in general economies recovering from the impact that had, inflation starts to heat up. All these like central banks have interest rates really ultra low, and they're beginning to start to think about increasing them and decreasing the amount of money supply into the economy, or the stimulus they've been doing, etc., etc. So therefore, that's how you have this like web of things that all connect to each other. And yeah, it is complex, but it's something that you can get into more down the line. So here the market then prices in, we could say investors and traders price in that better figure. It was a shock to the markets. It wasn't expecting that. And therefore you only really get moves. So it could be high impact. It means that everyone's potentially watching that data point, but it's only actually high impact if it's a surprise figure. So that could happen. Let's say you get a big spike to the downside, one big candle that comes down here, and all of the that's then being priced in at a better figure. A lot of the time, you'll then whip straight back up again, or you'll just have like a bit of a crazy movement over time. So they're not really kicking off new trends. That all of these data points are, apart from the really big ones like central bank interest rates, etc., are shorter term moves. So you'll find that if retail sales in the UK comes out way higher than expected, could be let's say 1.5%, then that may spike the pound to the upside, because that's more people spending money, which could put upwards pressure on inflation, which means the central bank may need to take certain actions sooner to increase interest rates, decrease stimulus, and that could make the pound more attractive to investors. Again, that big web of things that all connects together. So therefore, on their own, they're not necessarily changing the trend of markets, but they're often very short-term spiky price action. So let's take an example of the pound quickly, and say that you have GBP USD. So in this case, we're just doing pound / dollar. And so GBP USD, and the market, let's say, has a previous resistance level up here, and the market's coming into it from below like a couple of months later. And the market's going really strong, and let's say pound is just strong anyway, and the dollar's sort of a little bit weak at that time, and you get the market pricing in 0.5%. So of course, this is only one of like a million things the market's pricing in at the time, and just general price action on the day. But if this figure, let's say, came out really high, way higher than expected, came out at 1.5%, that's quite big of a jump for retail sales. So there's way more people buying than expected. That may temporarily push the pound up even further than it would have gone anyway. And then it could come into a big level, and then that's an excuse for the market to be dumped back off again. So that's why I'm saying that a lot of the time, these are short-term events, the vast majority of the time. So therefore, they can't really be predicted. Don't try and predict what the figure is going to be. And don't see something like this happening, where you see that comes out 1.5, you see the market has gone up, and you think, right, so if this candle closes bullish, I'm going to buy it now, because I'm buying because retail sales went up. That's not really how fundamentals work, because that's already been priced in. It's already happened. So you then could be buying into resistance when everyone else starts to then think, right, okay, that move's been priced in. That's done. Let's forget about that and go back to the charts again. And then maybe it sells off. So don't sort of jump into news just because it's positive or negative. Often it's just a short-term price action. And if you zoomed in, let's say, on like a really small time frame, to like a 5-minute chart, some news will really look like this when it goes like that and then ends up roughly where it started. So it's often an excuse for short-term volatility. So that is sort of how economic indicators can affect the charts. So often quite messy. Let's now have a think about, just briefly, the central bank idea that I was speaking about before. So when you look at any fundamental event, it always comes back to central banks. So I want to quickly mention things like interest rates, because if you look at next week, you will see that you have a data point on Wednesday that says BOC interest rate decision. And that's high impact, but it doesn't look any different than something like pending home sales. But it's a lot more important to the market than pending home sales might be. So BOC is Bank of Canada. So you've got like ECB, European Central Bank, BOC, Bank of Canada, BOE, Bank of England, all these different central banks, and of course the big one, the Fed from the US, the Federal Reserve. These are the central banks of these countries. So they supply the money to the economy. They control the supply. They control interest rates, lending, borrowing, all these sorts of things that affect the entire economy. And therefore they also affect how attractive that currency will be for investors. Because the biggest market in the world is the bond market, which is the debt market. So in the UK, it's called gilts. In the US, it's a treasury bond. So essentially, it's you lending money to the government, and you're essentially buying debt from them. You then own that debt. They pay you an interest on the debt. It's a safe place to park your money. You're sort of trusting the government instead of trusting a company or a person. And it's a low return, but it's safe. It's like a safe yield, so to speak. So if interest rates increase, it means that the rate paid to lenders on those bonds, which is again the biggest market in the world, there is more debt in the world than there is money, right? So it's such a big market, it's bigger than all the money that exists in the world. It's crazy. So therefore a higher interest rate is going to mean that people want to maybe buy more of that currency to lend it to that government to then get some return on it. So let's say that you have someone here on the left, let's say it's you on the left here, and you have £1,000 that you want to invest into a government bond somewhere. And let's say that the UK is paying you 0.5%. So I'm just making these figures up, but let's say the UK pays you 0.5% for that bond. So you know that if you buy, let's say it's a 10-year bond. So over those 10 years, you get 0.5% a year, and then your money back at the end. So the UK is offering you a 0.5% interest rate on a 10-year bond. But then let's say the US, again, this is not real figures, I'm just making these up, are offering you 1% on the same thing, on a 10-year bond. I mean, you would trust the US government to pay you your money back. If it was, let's say, Turkey, a Turkish bond is probably going to give you a lot more return, but you've got a much lower chance of getting your money back or all of it back at the end, or them to even keep the promise of paying the interest rate. So here you've got the same bond. If you don't understand how these work, I'm not going to go into them, but you can obviously research a bit more. But a bond is literally just give someone money, and for a certain period of time, you lock that money up. They give you the interest rate on that money, and then give you your money back at the end. But for this sense, you're providing that to a government. So if you're in the UK, it might be more favourable. Let's say the US increased the interest rate from 0.5 to 1. Well, now you think, well, if you've got millions or you're a pension fund, there's billions or something like that, then it might be worth moving that money out of the UK, buying dollars, and investing into US government bonds because they pay 0.5% more. So therefore you'd be doing the transaction of selling your pounds. So essentially you're selling GBP to then buy dollars, because you're moving your money from the UK to the US, investing in US government bonds, buying those government bonds. That's the first step. You sell pound, buy dollar. You then invest in the bond. So you're essentially being given this sort of like electronic bit of paper by the government saying that they owe you that money, whatever it's going to be. And then when you sell it back again, maybe in 10 years, you reverse the transaction. It just really, in a basic, simple sense, there's obviously a lot more to it than this. But that's why an increase in interest rates, among the many other things, it affects everything like mortgages, borrowing rates, lending rates for credit cards, banks, etc., etc. Affects everything. But from a broad market perspective, we're just thinking now for this. So when the interest rate increases from one country, then that's why things like the jobless claims going down might make the Fed want to raise rates quicker because employment's going better than they expected. So it all relates back to this sort of idea. And interest rates affect everything. The entire world economy relies on borrowing and lending, and interest rates set the rate for that. So that's why it's so important. So that's how central banks, will control inflation, etc. That also, if inflation is running super hot and inflation is running really high, then that means people are spending a bit too much money. If they want to reduce how much money people are spending, then they could increase interest rates that you're more encouraged to save because the banks will offer you a high rate for savings. So it affects everything in that sort of way. But again, this is just it's meant to be a basic introduction, so I don't want to go any further into it than I will now. So yeah, that's central bank events. That's why you should always pay much more attention to these. Now, if you were to look at the charts, and let's say that the market is making a pretty crazy move, but the Bank of England, let's say, is doing their thing in a couple of weeks, but the market seems to be going really strong, it's pricing in what it expects to happen. So we're going to do a little transition now across to the charts, where I will see you to speak about that idea. So here we can see a chart on the left-hand side of pound dollar, and on the right-hand side, an article from Reuters saying sterling hits 4-week high versus dollar as rate hike anticipation builds. So this is basically the market moving off the back of what investors are expecting the central bank might do. And of course, this is that idea of pricing in again. So it's like more than just pricing in a small data point. It's pricing in a really large market moving event that everyone is watching. Because at the moment, because of the current situation, interest rates in the UK are very, very low. This could be like the first time that the bank starts to increase rates again, becoming what's called hawkish, and therefore the market's starting to price that in. So dollar's been dropping, and that means dollar's been dropping in general. So euro's been going up, Aussie, Kiwi been going up, but pound is doing extra well because it's also an expectation for the the English central bank, the Bank of England, to potentially start increasing rates quicker than people were previously expecting. So therefore the pound's going to get bought up a bit more in expectation for that to happen. So sometimes you will have these sorts of like movements that are just in the background. So it's not one specific candle that is pricing this in. It's just the general market is stronger than maybe some other markets. So if you look at euro dollar, that's also been going up. But because there's no expectations for the European Central Bank to do this yet, the Bank of England is stronger in their monetary policy in that way, as in like the currency is appreciating more than the euro because there's divergence between the ways those two central banks are acting. So you then go to euro pound to see how these two relate, and euro pound's been going down. So both pound dollar and euro dollar are going up against the dollar, but pound is doing better than the euro. You can see that by going to euro pound because of this news article. So not because of the news article itself, but because of what the news article was mentioning. So that's just a quick sort of idea there as to how like articles and broader news, like macroeconomic background events, can also impact markets. So I could speak for many hours on these subjects, but that is an introduction to the idea. So you may have to watch this a couple of times just to make sure you fully understand it. And as time goes on, as you read the articles, reference it back to the charts, see how economic indicators affect the market, read the little breakdowns for those, you will start to gain a better understanding as time goes on for fundamentals. So that's it for part 2, and I will see you on the next part.